there's so much more speed on the hard money side. You call, I fund. That's kind of something we always go back to. So also from an investor's perspective, they want us to feel like hard money because that has sticky clientele, right? That keep coming back for more and more. And we see deals that are interesting, maybe a little bit off the beaten path, maybe that we risk adjust and charge a higher fee for. We can pass greater returns back to our investors because we're able to charge a premium for a premium service of funding something in as little as 2 business days. Our job is to balance feeling strict and rigid, but also flexible and accessible.
So with the increase in interest rates, while they've made it a lot more difficult to find cash flowing rental properties in markets like Denver, Colorado, it's also opened up other avenues to go out there and invest. So as always, one door shuts, another opens up when it comes to the world of investing. So in today's video, I'm going to explore the world of investing in debt funds, aka being the bank, then using that to go out there and invest in the markets with better yield or better cash flow, while you're also able to create some diversification in your own portfolio. So in today's video, I have the founders and general partners at Dynamo Capital. Now, they run a debt fund in Wichita, Kansas, and they flew out here to come discuss debt funds with us and also talk about their market. So I have Justin and Matt in the studio. Welcome, guys.
Hey, thanks for having us.
Yeah, thanks for having us.
So this is going to be a great podcast. We're going to go through lots of different details on here. But first, I want to start off with the basics because debt funds or being on the credit side of the investing world is new to a lot of investors. Many people start on the equity side where, hey, they put down a 20% down payment, or they buy a house and then go to the BRRRR strategy to pull their equity out and have a rental there. That's how most investors get into real estate investing. Now, a few years ago, I started investing in debt funds because that was one of the ways we could achieve a double-digit cash flow here in Denver, Colorado. So, Justin, how would you explain a debt fund?
A debt fund, in the simplest of terms, is a pooled investment vehicle that specifically lends to consumers in some form or fashion. Whether it's real estate or non-real estate, there's a lot of different debt funds out there that specialize in a variety of different asset classes to make investments in.
And what type of debt fund is Dynamo Capital?
Dynamo Capital is a residential real estate debt fund. So we specialize specifically on 1 to 4 unit real estate, and we loan specifically on those asset classes. Although we will look at other types of assets in an opportunistic fashion, we are specifically a 1 to 4 unit real estate debt fund.
Yeah. Now, I've been interested in lending money for years, but I've shied away from it because I've talked to a handful of investors where they've lent a lot of money through the IRA, and that's a very common vehicle, like a self-directed IRA for an investor to do a loan to someone fixed flipping. Hey, here's a $75,000 loan to go out there and do a fix and flip, or here's a $100,000 loan. Now, the two issues that I saw with that was, for me personally as investors, I didn't have the time or the expertise to go out there and find the investors and be able to go underwrite the property and underwrite the person as well. The second thing was the foreclosure risk, because in real estate, it's always a matter of when, not if. Something bad happens, no matter what side for equity or credit. It's always a matter of when, not if. We all know, hey, it's a matter of when a tenant trashes a property or when a water heater goes out. Same thing on a debt side is when a foreclosure happens. And so that always excited me about investing or being a lender, but also maybe shy away from actually lending my own money because I didn't have the expertise, and also I didn't want the foreclosure risk on there. And that's one of the reasons I really like the debt fund is, so what I can do is rather than me loaning directly to, Johnny the fix and flipper, I can invest into a Dynamo Capital type debt fund. And then you guys, the loan officers, the debt fund managers, you're out there doing all the work of finding the properties, underwriting them, managing the paperwork, managing draws. And when foreclosures happen, you also handle as well. And so the other thing on there is you get diversification. Now, when it comes to explaining diversification, how would you go about explaining diversification a debt fund provides for investors, Justin?
Yeah, so there's diversification in a number of different fields, right? There's diversification amongst asset classes, right? We're doing 1 to 4 unit properties, but we may also do some land. We may do some small balance commercial if it fits within our credit box. So there's diversification on the asset classes. There's also diversification geographically. right? We're based out of Wichita, Kansas. We do a lot of our loans in Wichita, Kansas and surrounding area, but we do have diversified our book of business into other markets as well. And for out-of-state investors as well, if they're investing into our fund, right, they're essentially diversifying their geographic risk, right? If they're located out of Denver, right, they're used to Denver real estate, right? Maybe this is an opportunity for them to invest in Wichita real estate passively. And then we also have diversification amongst different types of loan programs. So we don't just do fix and flips. We may do ground up construction. We may do the debt service coverage ratio, permanent takeout loans. So there's diversification amongst a variety of different factors inside the debt funds that you could get as an individual loaning money, but you'd have to have a pretty big bandwidth and you'd have to probably immerse yourself into this space. There's so many gotchas in the lending space that it really is, it scares me when I hear people doing it by themselves, right? If they're a W-2 employee at a law firm and they're just, hey, I've just got some extra money laying around, let's make some money, passive income, right? They're not spending all day, every day looking through, the appraisals and the title work and, well, maybe the attorneys are, but, bad choice. They're not going through all those steps. They don't have the process in place, the software in place, the operations in place, and the loan pipeline to make it a sustainable business for the long term.
Now, I want to talk about market some because, like I said, I've invested in multiple debt funds, Dynamo Capital being one of them. And, I like the way you guys do deals. We have it structured, but also I like the geographical diversification.
Mm-hmm.
Now, up until probably about 2 years ago, I had 80% of my net worth within a 20-mile radius of where we're sitting at right now. Well, now it's below 50% because I started diversifying across other asset classes, some like debt funds, other products, but also geographic markets. And I have been a big fan of investing, more and more out of state in the Midwest because there's generally better yield and also they are more landlord-friendly markets. And as I've gotten to know you guys more and, learn the market more, I've been really impressed with the Wichita market. Matt, can you talk to us about what the Wichita market is like? Because we have a lot of people from Colorado and other parts of the market that they're not familiar with Kansas or Wichita.
Yeah, well, I don't want to tell too much about it. I want my borrowers to still be able to win houses, right? It's a really exciting market. It's just in talking to you about what Denver's like, the opportunity that Wichita presents is so much more affordable for really the same assets, right? Just from our day-to-day life, most of our borrowers are picking up houses for between $55,000 and $85,000, putting
so 55,000.
Yeah.
Okay.
Yep, five figures there, right? Pretty small. It's not a very expensive market. Putting a few $1,000 in it, 10, 15 grand, and then turning around and being able to rent that out for, somewhere between $1,500 to $1,800 a month, depending on the asset. So it's a great spot from a cash flow perspective. The ability to pick up and add a lot of value into a house from a equity perspective, but not have to spend too much, is a unique property of Wichita. We've had a lot of clients from California or maybe the coasts who have kind of heard about Wichita in passing, or maybe they watched the big Final Four run that the Shocks had, right, and kind of put Wichita on the map, because we just don't have any real national exposure that most people have heard about, right? If you mention Wichita, you either get asked do you know Dorothy, right? Did you drive a tractor here? Or the Shockers, right? They have the
those
weird
are
guy, right?
Three things you get, right?
That is really the main questions that you get. And they don't certainly say, hey, can I buy a house for 75 grand? And would it be plenty rentable to a tenant for quite a bit of money each month? So yeah, it's a great spot in terms of being able to achieve consistent yield. I'm biased, but the people of Wichita are great. You have really strong renters and really good employers around Wichita that bring consistent income for their employees, and it's a great really elastic market.
And something that you said one of our earlier meetings is that I've done a lot of investment in Des Moines, Iowa. That's probably the Midwest market where I've done most of my investing through. And then you said Wichita is like Des Moines 20 years ago.
Yeah, I think it's 20 years behind where Des Moines is. I went to school in Iowa, so I was kind of around Des Moines, and it really felt like home, or like what the future of home would be. Every time I'd come back to Wichita, it had grown, in this direction or that direction, and so kind of projecting what it feels like it'll be in the future. It does feel like a Des Moines. Kansas City is a little bit between Des Moines, or a little bit ahead of Des Moines, I think. I think Des Moines kind of in that Kansas City range. So, Wichita is seeing an uptick in people moving in, especially as California dumps out and, people are flooding into Texas, but Texas is only 2 states away from us, and that's filling up pretty quick. So I think we're going to continue to see more people come there. It's going to continue to grow. By example, we have a 40,000 door shortage in Wichita alone. So there's a need there for housing, affordable housing. And that's something that we're, actively trying to help fund and finance, and ultimately make Wichita, a happier, healthier place with more places to live, and remodeled and refreshed homes through the BRRRR method. And so that's our one way of helping that. Justin and I are not getting out and swinging the hammers to put those houses into,
Speak for yourself.
Yeah, tip top. Well, I'll bet on it. Tip top shape. So this is our way of helping.
Yeah, and I want to kind of take a step back, and because I know for my evolution as an investor and all investors I talk to, a lot of people have invested out of state, whether it's Colorado out of state or California out of state, into like a Midwest market. And often what happens is, the numbers look so attractive on paper. Like, I can go out there and buy a house for $70,000, rents out for $1,800 a month. It's, it's very attractive. But out-of-state landlording and out-of-state, property doing a BRRRR method is just very, very tough. Mm-hmm. I've seen more failures than success stories. And that, then comes down to like, hey, just, lack of local knowledge, and also just you're 500 miles, you're 1,000 miles away, which just makes things very difficult, since, real estate's a very usually local hands-on. And I very much have, like, one of my light bulb moments was like, oh, well, I can get exposure to a high yield market where the BRRRR method, the buy, rehab, rent, refinance, repeat method, we can go out there and put together a rental portfolio. It makes sense, but I can do that through vehicles like a debt fund, where I can get the exposure on there, but not have to have the hands-on, risk and the headaches on there, but typically still achieve like a double-digit type cash-on-cash return. Mm-hmm. Now, I want you guys from a high level just actually walk us through like what a BRRRR property looks like in Wichita, because everything we've been talking about, talking about the Denver market and then the Wichita market, we're kind of at opposites right now. Mm-hmm. Yep. So how would you just high level, walk us through a typical, like, one of your investors who's out there doing a BRRRR, like what the market looks like, and then how Dynamo is helping that investor build the rental portfolio? Yeah,
no, absolutely. I think the easiest example is when we've kind of talked about quite a bit. So we had a client buy a house in a pretty desirable neighborhood for $144,000. They got it from a wholesaler. So they got the property off market. That's where most of our clients are getting their properties. Bought the property for $144,000. It needed $48,000 worth of rehab, and it was going to be appraised at $280,000. Or it appraised for $280,000, subject to all those repairs getting done. He had not decided whether he was going to flip or refinance the property. By the time he was actually complete with the rehab, he ended up refinancing the property into long-term debt, which we facilitated. And he's renting the property out for, I think, $2,500 to $3,000 a month. I don't remember exactly. It's been quite a while, but that's a pretty standard deal, right? That's probably even on the higher side of the types of loans that we're doing in Wichita. Another good example is we've got a client who tends to buy $50,000, $60,000, $70,000 properties. And he tends to rent those out for $1,000, $1,200 a month. He may put them on Section 8. He may not. And what we do for him is we fund the acquisition, and then we facilitate takeout debt for him as well. So we would tend to fund up to 100% of the acquisition price, assuming it sticks within our underwriting guidelines of 75% of the ARV. And he's a happy camper because he gets into it with very little cash exposure. We know him as a sponsor and as a guarantor, so we have a really good rapport with him. We understand how he operates and what he does, and then we refinance that into permanent takeout debt, 30-year fixed rates as of today, high sixes, low sevens. Obviously that'll change over time, but as of today, that's where they're at for this particular borrower. And he's got a property now that's debt servicing at 1.3, 1.4, 1.5, and he's very pleased because yes, he's only it's only a couple $100 a month, right? But he didn't have to invest very much capital, right? The cash on cash can be very, very high in his particular circumstance.
All right, so I want to kind of unpack because you talked about how it looks on the investor side, and you touched on some of like how how you as the private lender, how you guys are going in there and filling some of the needs on there. Mm-hmm. So taking a step back from like the fix and flip and the long-term takeout financing, I want to kind of take that 50,000 foot view, Matt, and talk about like kind of like the four main buckets of lending out there, and then zoom back down some specifics because as I got learning into like how to lend money, I used to get very confused on how the lending matrix was. So Can you walk us through the main like lending programs out there?
Yeah, absolutely. First, the types of loans that you would expect from a naked agency perspective, whether they're conventional, FHA, VA, USDA, the standard loans that everybody's familiar with, right? When you think of buying a primary residence, those are standard agency loans. Now, there are products within those agencies. However, they're pretty difficult to achieve, whether you have to give a ton of information from an underwriting perspective, your W-2s, your 1099s, your this, that, and the other thing. I mean, if you have a big portfolio, I mean, you're giving information on the rent, the current lease, right? You have to make sure all your documentation's nice and tight. You have the current lease, you've got the insurance, the taxes information on all of that stuff is going to be required. So it's very difficult for an investor to achieve a loan through standard agency loans typically. Then you have bank loans. They're going to have a little bit more, I think, flexibility in like a particular niche, whether it's a doctor's loan or a HELOC, or they have some different products. And then obviously just your standard bank loans, and they're going to do your FHA, VA, that type of stuff as well. And then you have some more on the private side, like private equity funds that specifically target real estate that have programized the mortgage in for their returns at their level, right? So they're handing out loans and doing something similar to what we're doing. And then you have true hard money. It's just that fourth category of like, I've got a rich uncle, right? This is obviously a made up story, but I've got a rich uncle that's just I call him and say, hey, I need 200 grand to buy this house and I'm going to flip it for 300. Right. And he says, okay, cool, man. We'll send you the money. Right. There are different pros and cons to each of those buckets, right? Standard agency, what you're going to get. I know the VA guidelines. I know the FHA guidelines. It's what Justin and I did prior to getting into commercial lending. We were residential mortgage brokers and we knew those guidelines inside and out. He did. I probably didn't. Right. But he was always a good resource for me. Those are going to typically have some lower fees and lower rates. But that's very different in terms of what is out there. And then on the hard money side, it's unpredictable, right? That rich uncle that I call, he might be getting a divorce next week, right? And he's a little bit tied up on cash and I can't get the money. And when I need it, I can't have it, right? I know that the FHA and the VA loans, those are going to fund so long as I check the boxes. So what we have to balance as managers of the fund is feeling like standard agency loans and the consistent, process oriented underwriting, so our investors feel safe, right? For all of our LPs, that we are protecting fund capital and underwriting to very clear guidelines. But then also from a client's perspective, they want to know that they're going to get consistent terms and consistent experiences with us. That when they call, this is what you're going to expect to pay. You're going to pay these amount of points and this amount of rate. And then it's predictability. But on the hard money side, there's so much more speed on the hard money side, right? It is you call, I fund. That's kind of something we always go back to. So, I want to be able to, we know virtually all of our borrowers, especially lending our own backyard. We have shaken the hands and looked in the eyes of the majority of our borrowers. And that helps us feel really comfortable with the asset and the way the client is underwriting the deals and all of those things. But, I want to be able to have a client call me on Tuesday and say, hey, I've got the opportunity to buy 123 Main Street. I had to close it on Friday. That was how, we came to the price that I'm willing to pay for it. And ultimately I want to be able to go, yeah, man, like we'll get you the money for that. Right. Obviously they have to provide the things that we need to underwrite the deal and make sure that everything is nice and tidy. But, with experienced clients, they know what they're going to get, and being able to fund that money quickly is a big deal. Also, from an investor's perspective, they want us to feel like hard money because that has sticky clientele, right? That keep coming back for more and more. And we see deals that are interesting, maybe a little bit off the beaten path, maybe that we risk adjust and charge a higher fee for. Whatever that is, we can pass greater returns back to our investors because we're able to charge a premium for a premium service of funding something in as little as 3 business days. So our job is to balance feeling strict and rigid, but also flexible and accessible. And that is kind of, in a nutshell, the balance of a debt fund, in my opinion.
That's a great explanation. Now, Justin, tell us about just like who Dynamo Capital is and kind of the origin story on there. Because, I think it's always great to know, the people behind the debt fund, because, as you're out there, looking to potentially invest in a debt fund, hey, you have to see, hey, what market, what their loan products are, what the numbers are like, what their lines, all that items. Plus, it's also like, hey, who is the people running the business? Who is the jockey out there, wheeling and dealing? Because ultimately, like, they're going to, make or break the business, and therefore the investors' returns as well. So how, kind of tell us the origin story of Dynamo Capital.
Yeah. So I started in the financial services sector as a wealth manager when I was 18. Got securities licenses and all that stuff, and realized very quickly it's going to be very challenging for me as an 18-year-old to get somebody to invest their money with me. So I very quickly made a transition into mortgages. I knew somebody at the time that was starting up a mortgage company. He had been an experienced loan officer. I came over and instantly found that this is where I need to be. I need to be in the lending space. Was there for a couple of years. Started doing very well. And in 2020, I decided to go out on my own and make an independent mortgage brokerage. So I opened up one of the only independent mortgage brokerages in the state of Kansas. And we very quickly became the largest brokerage in the state of Kansas, which, is tallest midget, but, that's okay. And we did very well, and slightly previous to that, myself and Matt became aware of one another. He was in the market to refinance his house. His realtor referred him over to me. He called me on a Saturday, which was very rude.
He answered.
I did answer the phone. And, we ended up doing the refinance together. And we created a referral relationship from there. He was in the foundation space at the time. And he was, he's always been very creative about how to sell and how to continue to grow his business. And he's like, well, all right, well, rates are coming down and most people haven't refinanced yet. And they probably have a lot of equity. So I should maybe utilize cash out refinances as a way to sell larger foundation projects. And so we created a referral relationship with that dynamic, and I'd always try to pull him over and yeah, you're a good sales guy, you should come on over, rates are low, you're gonna have a lot of fun. All lies. Eventually he ended up coming on board, and not even 2 weeks after that the rates started to move up. So I'm not sure if it was a bad omen or what it was, but he brought over a big pool of investor clients, and I had built a pretty good, sizable portfolio of investor clients as well, who we wanted to service on their flips and on their takeout loans, but we didn't have good options, right? We were constrained to conventional Fannie, Freddie, FHA, USDA, regular agency type loans that did not provide the right outcome for the investors.
Didn't provide the best outcome.
It didn't provide the best outcome, right? It was good in some cases. It was very difficult and tedious in most cases. And a lot of the investors were like, well, I'll do it for the 3% rate, but that's about it. Didn't like it. So we always had that kind of in our back pocket. As rates started to go up, we started to shift our focus to the investor market, property investor market. We became more familiar with the wholesale commercial lenders that were out there, which a lot of people would know. But we got familiar with them through a variety of different sources, and started to directly broker fix and flip, ground up construction, and DSCR takeout loans to these outside parties. And we had a lot of success with that. We were really the only one in Wichita that was doing it at the time. And still now to this day, I mean, we really are the only people that are doing it in Wichita. The market out there is dominated by banks and credit unions. And we know exactly what their terms are. It's going to be a 5-1 arm on a 20 to 25 year AM. And it's going to be, prime plus or minus a quarter. And that is what it is.
Plus a couple laps to the loan committee, right?
Yeah. Plus,
no kidding.
Plus 60 days, right?
Plus a good deposit into the bank, right?
Right. So we identified, immediately a niche that we could fill with this 30-year fixed program that's coming in 1% or 1.5% lower than all the other credit unions. Longer AM, shorter time frame, and no personal income that needs to be associated with it. So we got very invested into that market, and that became kind of the impetus for the actual fund creation. We started with these agency loans. We moved to better with brokering commercial loans, and now we believe we're at best, good, better, best in the debt fund, where we're able to cater exclusively to these property investors, cater loans to exactly what they need to succeed in their business. Because if they succeed in their business, that means we're succeeding on the loan side and the loans are performing well. Succeed in their business, and then also create long-lasting relationships by facilitating the front, middle, and end of the entirety of that process.
I want to just talk more just basics of debt funds and they operate. So I know you guys are very plugged into just the debt fund community, and you go to conferences and you're up to speed with your colleagues. What type of loan products does your typical debt fund offer out there?
So most debt funds almost every debt fund offers some sort of fix and flip or value add program in some capacity, right? So you're going to see your regular fix and flips. Sometimes the debt funds stop there, and that's all they do. Some of them, more recently, I don't know why it's taking them so long, they're getting into the ground up construction space. So they generally split those out as two separate loan programs. But we kind of talked about the housing shortage. We've talked about that, all week. Huge housing shortages all over the country. The only way not the only way, but a big way to solve that is by building new product. And so there needs to be a liquidity tool for these builders to be able to build these properties when the banks are tightening up, or they don't want to leave $1 million in deposits in the bank. They come to people like debt funds. And then some debt funds as well will also do the takeout financing as well, whether it's DSCR or some other form of permanent takeout. Some lenders do, some lenders don't. It's really dependent upon the debt fund and how they're structured. Now we provide the entire product suite at Dynamo Capital. We do everything. We don't do everything, but we do all the ones that I just mentioned, as well as we have what we call an opportunistic bucket, or an allocation of loans where they don't necessarily fit in either of those categories, but they're clients that are coming to us who we have good relationships with, that the deals make sense.
All right. Now, earlier we talked about foreclosure risk. And it's a matter of when, not if, foreclosures happen, as with anything in real estate. So what is the industry average for foreclosures across a hard money lender or a debt fund?
Yeah, the average foreclosure rate is south of 1%. The industry average default rate is 3%. So a lot of those defaults end up pulling out of the foreclosure.
Wait, say that again and explain the difference on there, because that sounds very nuanced to me.
Yeah. So the difference really is a loan can be in default and not necessarily be in foreclosure. So in our space, default is anything that's 91 days delinquent.
And you said that's 3% industry average?
Typically. Yes.
Typically.
Yep.
Okay. 3% in the default, which is 91 days.
91 days delinquent.
Okay.
Yeah. So there's delinquent, there's default, and the default is generally leading towards foreclosure. And generally the foreclosure is less than 1% of a portfolio. So it is a risk that's out there, right? Like you said, it's not an if, it's when, right? We're going through, we're a relatively new debt fund, right? We started in September, we started loaning in September of 2023, and we're doing our first foreclosure right now. So we're going through that process. We have a client that's, past the default stage. They've gotten their notices, notice of default, and now we're going through that process. Now, Justin and Matt don't know everything there is about foreclosure in every state that we do loans in. But we have a great legal team that handles all of that stuff. And we've engaged them for specifically these types of purposes. They're experts in their field, in private lending and foreclosure, and expediting that process for us. And, industry average as well, a lot of people are like, oh, foreclosure. Okay. Well, you're going to lose money as the fund, right? No, historically speaking, what we've seen from our contemporaries is when an REO, a real estate owned, a foreclosed property is taken onto the balance sheet and then sold afterwards, generally there's profit that's made, usually around 5%. Over the note rate.
And let's talk about that, because when I first heard that, like it very much surprised me.
Mm-hmm.
And then I started understanding how underwriting works for, lenders, and it started making sense where it's like, oh, well, if you're going to foreclose, you lose money. Well, when you look at take a step back and look at the equity side versus the credit side, the credit being the bank side, very rarely does the bank lose money. It's much more common for the equity investor.
We work very hard to not lose money.
Yes. And that is one thing on being the bank side is they rarely lose money, way less frequently than an equity investor does.
Yep.
So when a foreclosure happens, I know, it's never anyone's intent to go out there and, hey, I want to loan money to then, indirectly own the property.
Right.
But talk about the underwriting guidelines, like the basics of like loan to value, loan to cost on the ARV side, so people understand how you underwrite it. I say debt funds in general, and also how that leaves margin depending on different takeout strategies, whether it's a flip, a refi, or foreclosure.
Yeah. You want to touch on that, Matthew? Would you like me to dive in here?
I think you'll say it a little easier than I will.
Okay, great.
A little long word. A little long
You are
word.
a
I could
little
barely
long.
spell LTV.
Yeah. So there's two really big components that we look at when we're underwriting a loan. You got yourself on that one. We haven't even gotten into the booze yet.
Nope.
Yeah.
Carry on.
Giggly
Carry on.
boy. So there's two really big components that we look at right now. Obviously, we're looking at the sponsor and the guarantor, right? What's a credit score, right? We generally do a soft credit pull. We're going to look at title and insurance and all these types of things. But when we're specifically looking at the asset, which is truly what we're interested in, because at the end of the day, right, if the loan defaults, we got to be okay with that asset. We want to understand both the loan to cost, and we want to understand the loan to value. So the loan to cost is going to be a function of the overall loan that we're providing divided by the total cost to get the loan or get that property to its ARV, assuming that we're doing a ground up construction or a fix and flip loan.
Wait, say that again and walk me through some basic numbers.
Yep. So I'll say it one more time. I'll say it.
I'll say it differently.
Would you like to say it differently?
I'll say it differently.
Okay, great.
Loan. So let's take the very basic example of a fix and flip that I'm going to purchase for $100,000. I'm going to put $50,000 of rehab into it, and it's going to be worth $200,000 when we're said and done. So from an LTC perspective or a loan to cost perspective, the loan is going to be the purchase price plus the rehab, right? So in this case, $150 against the loan that we're going to do. And from our perspective, we will lend out 100% of loan to cost up to 75% of the ARV. So with that said, we would give, in this particular case, $100,000 on day one to purchase it, and then give you a line of credit of $50,000 to rehab that property against it. So in this case, the loan to cost is 100%, right? Because it's 100 plus 50 for the $150,000 loan. From an LTV perspective, at that point, you're looking at the loan amount versus the future ARV value that you have. So in this case, it's $200,000. So 150 on 200,000 at 75%. So that fits our particular guidelines at Dynamo Capital. 100% loan to cost, 75% of the ARV.
Yeah, and those are obviously the maximum underwriting guidelines that we would get to in terms of leverages. Our portfolio right now is sitting at an average of 82% loan to cost and 63% loan to value, meaning on average, our borrowers are putting 18% skin into the game. So we'll use a similar example. If it's a $100,000 property, they're putting $18,000 down on day one, and they're going to have an $82,000 loan on day one, meaning we instantly have day one equity in the property as the fund, right, and the client, obviously. And at 63% loan to value, I didn't make that math easy for myself, but
you didn't.
Yeah, so I don't have my calculator with me, but it would insinuate a value, a loan to value of 63%. So if it's $100,000 ARV, we'd be at a $63,000 all-in loan. for that particular. I didn't make the math really easy on myself at all, did I? So that would be generally what that looks like. So in the event that we have to seize the property, we have 18% of equity on day one if they did absolutely nothing to the property. Which obviously at that point, if we have to take the property back, we sell that property immediately, or we reach out to our network of investors that we work with locally in Wichita that want to take more properties because every investor is hungry for deals right now. If the property is not stabilized, or we elect to maybe finish the property for whatever reason, as the fund, there's still 38% upside in the property based off of the appraisals and AVMs, automated valuation models that we pull for each property before we fund it.
And those lower LTVs really speak to our clients' ability to find good deals that protect themselves. Because at the end of the day, the investors are probably the harshest underwriters compared to us, right? They are the ones that are investing their own dollars into this, and they're the ones that are personally guaranteeing the deals, and obviously we're guaranteeing at the fund at some level, but they have to protect themselves first, right? There's no DTI requirement like you have in the FHA world that protects a borrower from buying too big of a house, right, or having too high of a payment. There are no limiters around it. So the investors
besides our leverage, and even then, even though the leverage could make sense for a deal, right, it still may not be profitable enough, right, to make sense. And we have those conversations with borrowers too, especially newer borrowers that we, that are newer to flipping or investing. We have talked to plenty of clients that are deals that aren't profitable that technically fit our guidelines. So we want to be partners to our real estate investors. Not doing loans just for the sake of doing loans. And well, if you lose money, you lose money, or you break even, right? Because then they're not going to come back. They're not going to come back to us. They're not going to want to continue to invest in real estate. And real estate market truly needs liquidity right now, and truly needs people to be excited about it.
Well, guys, this is awesome. I know we could go talk hours for more, and we will in other content. So for viewers, investors out there, if you want, more details on Dynamo Capital and how they specifically works with debt fund, reach out to us. Let us know. We have lots more details on what they do. We also have other content that talks more about debt funds and actually underwrites some of the properties from like the fix and flip loans, the DSCR loans, or the long-term takeout loans, and some opportunistic loans as well. So if you want more details on certain aspects of debt funds or Dynamo Capital in general, let us know, or search around the website to get more details. But Justin, Matt, I appreciate your guys' time in the video day. So thank you so much.
Yeah, thanks, Chris.
Thank you.